We'll now move on to our next section, which is on diversification and what are the benefits of bonds within a diversified portfolio. I suppose, generally it's considered good to have a range of options within a portfolio. What are the key benefits to having bonds within a bunch of investments, for example, equities, real estate, etc.?
Typically speaking, a bond will tend to mitigate risk from an equity portfolio, from an equity-orientated portfolio. So if one looks at a balanced portfolio that might constituents of maybe 50% equities, 10% alternatives, which could be infrastructure and property, typically you might have about 40% in fixed interest. Some of that fixed interest will likely to be long-dated gilts. So when the market is stressed out, you'll see a flight to safety, and that will mitigate some of the volatility of your losses from your equity element of the portfolio. But generally speaking, over the course of 3 to 5 years, which is really where you should look when you're looking at investing in bonds, and Darren mentioned earlier that a lot of the maturities on the orb are 5 to 10. What you are looking there is a total return of a bit of capital appreciation coupled with some income over that time. So it really should reflect the steady element of your portfolio, coupled with a little bit of insurance from, say, a gilt or a supranational that will mitigate some of those stresses and strains from your equities, which over 10 to 15 years, you should get a nice return upon.
Absolutely. And you mentioned there a couple of different types of assets within bonds, which is obviously government securities and corporate bonds. Now, both of those are traded on the Orb exchange. I just wondered if you could give us an idea of how, even within the bond asset class, there are these different types of diversification.
There is diversification. You think of what you would even consider to be quite a homogeneous sector, such as the supermarket sector. Now, Tesco, Asda, Aldi, Sainsbury's, they've got 4 different business models there. So even in a homogeneous sector, you can have different business models and different strategies, different balance sheets, etc. What you got to remember is when you buy a bond, the best possible outcome when you buy a bond is you get all your coupon payments on time and the company repays the capital at the end of the period. No one comes along and says, you know what, we've had a fantastic year. I appreciate the coupon's only 5%, but let's call it 7% this year. That doesn't happen. All those upside goes to equity shareholders, not to bondholders. So your approach when you look at a bond portfolio is you have to insure against the possibility of downside risk. You have to insure against the possibility of defaults and impairments on your portfolio. So it is important that you have a diverse portfolio of a number of different issuers. You're not overexposed to one particular name or one particular sector, because, like I say, the best possible outcome is you get all your coupon payments and all your capital when you expected to get it in the first place.
Yeah, absolutely. And so across even within sectors, there is this diversification which you can get. What are the relative merits of government securities and corporate, for example?
Okay, so talking about homogeneous, you think, well, a bond is a bond. If a government issues a bond and pays you a coupon of 2%, and because it's lower risk, then you have a corporate bond, an investment grade corporate bond, so one that has a simply good rating, you might get 3%. And then some of the issuers on the Orb, because they're slightly higher risk, or maybe their earnings are more volatile, they'll have to pay a higher interest rate again of say, they might pay a coupon of 5 or 6%. Now, the way we think about it as investment managers, we don't just look at the returns, we also look at the volatility of return. So that's really how much does the price jump around by? And we don't like prices jump around by a lot because that makes us nervous. And so what we typically find is that government bonds, provided we're not looking at very long-dated ones where the prices can jump around by the lot, so we've talked about interest rate risk, so then we're focusing on credit risk. And what we've found over the past few years is that when we have these periods called risk off, so that tends to be when maybe there's a recession, there's a financial market collapse, something bad's happened, that has been bad for equity markets. It's also not been so good for corporate bond markets neither, and government bond markets have done better in that environment, and vice versa. So when we've had better periods of economic growth and market sentiment's good, then these corporate bonds have performed much better than government bonds. So there's a whole, we're looking for things like economic sentiment, market sentiment, things that really drive these bonds in different ways.
Of course, one way to mitigate against the sentiment argument and to mitigate against that volatility in prices, of course, is if you've done your credit research, if you're happy with this organisation and you're convinced that they pay the coupon payments and give you a capital at the end, just hold it to maturity. You've completely mitigated all the volatility and all the sentiment out of the picture.
And that's the big difference between bonds and equities.
Yes.
With an equity, you've got a perpetual dividend that you're being paid and you hope that's going to grow over time. With a bond, you know from the outset exactly what you're going to be paid in terms of coupon, and also you're receiving your 100 back whenever it matures. And that's one of the reasons why investors like bonds in their portfolio, because of the certainty of returns.
In a sense, you could say that an equity is just like a very long-term, extremely uncertain paying coupon. It almost like a bond, but just perpetual.
The only downside with the equity, as I think we already touched on, is the fact that the dividend is discretionary. And the guys have said on the panel that you know what you're going to get with your coupon within the bonds. And I think for a retail investor, it might not always be easy to have a diversified portfolio. But I think if you can think of it this way, I mean, I know in the second quarter of this year, credit or risk actually outperformed duration because of the way the market's moved. Now that might have been, it was definitely down to the fact that the way that the market dynamics were affecting the way the underlying government bond curves moved. But take a step back, if you have an element of some, as we've said earlier, where you get a higher coupon but you're taking more risk at one end of your investment process, and then you have gilts at the top end, and in between you have an element of each individual credit, i.e. not sector per se, but rating, where you have AAA down to BBB-, which is investment grade, and then you have maybe a small element of high yield, which some of the retail bonds that have been issued have been, by definition, high yield. It does give you an element of durability as far as your coupon's concerned. You'll have an average coupon. And then, as we were saying earlier, if one of these bonds, unfortunately, does become, what should we say, earmarked for not actually paying the coupon, then your gilt at the other end of the spectrum will compensate for the fact that you might have some problems in one end of your portfolio versus the extremely safe end at the other side.
And I suppose another part of the argument is you can look across a portfolio and you can say, I've got 60% in equities and I've got 40% in bonds, but actually that's not necessarily the amount of risk that's being taken. Within that, you might have a lot, maybe 80% of that 60%, 80, 90% of your risk is actually in equities. Does that?
You could have bonds that are correlated highly to equity markets, which Jeremy was referring to. So typically a high yield bond, typically the index would be more correlated to equity markets. And that's because, back to the nightclub analogy, you're at the back of the queue. So if you refer to equity as perpetual bond, essentially, that's a very good analogy. Yes, that's right. But that means that you really are at the back of the queue. You might have white trainers on, they're probably not going to let you in because if anything happens, you lose all your capital. Whereas going through the covenants and going through the prospectus, you can claw a little bit back if you've got a bond, depending on the structure of it. But that's exactly right. And that's why, depending on your portfolio manager, there should be an element of proactivity within that. Or you buy good credits and you hold them to maturity, which, as Kevin said.
I mean, on that approach, are you essentially saying there that in that approach you don't worry about the volatility and you just say, I just want to own this forever or until it pays me back anyway?
It's the wonderful thing about bonds compared to equities. With equities, you're always trying to second guess what other people think. With bonds, on the maturity date, you either got all your coupon payments and got your maturity payments, or you didn't. It's very binary in that sense. So you don't, on your maturity date, you don't need to worry about anyone else's opinion. If you've done your credit research and you're happy with that issuer, you're comfortable that they can repay that issue, you know what your rate of return is going to be. And that's the wonderful thing about bonds.
I must say that's exactly right, because something, we talk about suitability, and that's, we know people that, I think most investors now become a little more sophisticated, and they look at it, they might have private school fees to pay. And they get that coupon of 6% or 5.5% annually or semi-annually. That's for them, it's a cash flow. They're not too concerned at all about the underlying volatility. And I think that that's the way people are becoming a little bit more sophisticated in the way they view their investments.
Though it has to be said, opportunities do arise. So for those active managers, and all four of us around the table here would consider ourselves active managers, We see times when bond prices fall below par and sometimes they rise above par, and those are perhaps trading opportunities. So we can buy or sell bonds depending on how we feel about them.
Yeah.
And even though we all look at interest rates and credit markets, we might all feel differently about the same thing too.
Mm-hmm.
Yeah, if there's one of those opportunities that Kevin said that you're really happy with the company and maybe others are misunderstanding it in your opinion, you can pick that up quite cheaply, and then it's another nice bond to put to your portfolio that you would be willing to hold to maturity. That's a good point, Darren.
Yeah.
Which is the wonderful thing about the retail bond market. It gives that opportunity that as things change over time, as your opinion changes over time, you've got the opportunity to dispose or pick up bonds at some point in the future.
I mean, you mentioned obviously you can have diversity within even a sector within bonds, but what about with an equity portfolio, for example, you would want to diversify across a number of different sectors. Does that also apply to bond investing, and how can you do that on? Or
I would certainly say so. At different points in the economic cycle, different parts of the economy will be performing poorly or performing well. And you think of a vertical sector, and you think of the production of plastic goods, for argument's sake. That involves upstream, which is the production of the chemicals. Then you got the manufacturing facilities, and then you got to convert that into a plastic product. So at different points in the cycle, each part of that value chain will be performing well or performing poorly. But if you've got all three components within your portfolio, you're really agnostic to where we are in the cycle, because at different points in the cycle, whereas your upstream component might be performing poorly, that means your downstream components might be performing quite well. So you can diversify away those risks by having a diversified portfolio and putting those verticals back together again.
Good example of that is the energy sector at the moment.
Absolutely.
So even quality companies have sold off simply because investors are running away from that. So there are some really good opportunities to pick up some little gems at the moment where the market's walked away, particularly short-dated bonds that are offering a very attractive coupon with solid covenants. Very worth looking into.
And a great example, commodity prices are low at the moment, which means commodity companies are struggling. But of course, if your input costs, and let's take the electricity companies as a great example, if your input costs are oil and gas, etc., that means that your margins are now quite strong. So if you put those two things together, that's one way you can diversify the risk associated with commodity prices.
Absolutely. Okay, well, that is all on diversification. Thanks very much for your views on that, and thanks for joining us.